What if a single 13-year head start could double the height of your entire financial tower permanently? Compound interest is interest earned on interest already earned. Every dollar you make starts making its own dollars. It's not a trick, it's arithmetic, and it's ruthlessly patient in your favor. At a 6.64% average annual return, the inflation-adjusted historical average of the S&P 500 since 1957, money doubles roughly every 10 years. Time, not contribution size, is the dominant variable. Auravale, a living, animated metropolis where every district represents a different financial behavior. The crumbling Borough Badlands sit in the east. The gleaming spires of Compound Heights rise in the west. Our scenario follows a 22-year-old who's just arrived in Auravale with a modest first paycheck and zero financial history. This profile represents every person who's ever stood at the starting line, wondering whether it's too early or too small to begin investing. Auravale's living time-lapse map lets us watch exactly what happens to a citizen's financial tower depending on when they plant their first investment brick. Let's run it. Our early starter commits to investing $200 per month beginning at 22. That's roughly $6.50 per day, less than most people spend on coffee and lunch combined. The money goes into a broad index fund, earning 7% annually. Investing $200 per month at a 7% annual return results in a total of approximately $1.1 million by age 65. The time-lapse runs. By age 65, the tower reaches $525,000. The early starter contributed their own money over many years. Compound interest built the rest without a single additional contribution. Now the tension. Across the map, a second citizen, same income, same $200 per month, same 7% return, starts at 35 instead of 22. Just 13 years later, watch what happens to their tower. By age 65, the second citizen's tower tops out at about $140,000. Same monthly contribution, same interest rate. That 13-year delay cost them more than they ever personally invested in total. That gap isn't a money gap, it's a time gap. No raise, no bonus, no side hustle can manufacture the compounding years that slipped by. Time is the one asset you can't buy back at any price. The late starter can't simply outcontribute the early starter. To match $525,000 by 65, the person who started at 35 would need to invest roughly $200 every single month at a 7% annual return. Research on intuitive thinking shows that people default to linear projections. We expect growth to be steady and proportional. Compound interest is exponential. It accelerates. The last 10 years of a 43-year investment journey produce more wealth than the first 30 combined. The rule of 72 makes this tangible. Divide 72 by your annual return rate, and you get the years it takes your money to double. At 7%, that's roughly 10.3 years. At 10%, just 7.2 years. The dollars invested between 22 and 32, the first 10 years, had the longest runway. Each of those early dollars doubled approximately 4 times before age 65. Dollars invested after 55 doubled only once. The early years aren't the warm-up, they're the engine. But here's the question that always follows. What if $200 a month is impossible right now? What if the starting amount is tiny? Does starting early still matter when the initial stake is almost nothing? Yes, dramatically. $50 a month starting at 22 can grow significantly by 65. $200 a month starting at 45 can produce over $150,000 by age 65, with consistent investment and a reasonable return rate. The smaller early amount still wins. Time is the multiplier. The mechanism is reinvestment. Every dividend, every gain, every interest payment is immediately put back to work. The portfolio isn't just growing, it's growing its ability to grow. Each cycle expands the base for the next. This is why that 13-year gap, the one that doubled the tower, isn't magic. It's simply more reinvestment cycles. The early starter ran 43 cycles. The late starter ran 30. 13 missing cycles compounded into a $282,000 canyon. The psychological trap is that small, early contributions feel meaningless. $50 into a market worth trillions feels absurd. But the math doesn't care about feelings. It counts years and reinvestment cycles. The size of the first brick is almost irrelevant. The age at which you place it is everything. This isn't theoretical. The S&P 500 has delivered an inflation-adjusted average annual return of approximately 6.64% since 1957. Someone who invested $200 monthly from 1980 to 2023 could have accumulated over $1.2 million with a 10% annual return, higher than the modeled $525,000 because nominal returns over that specific period averaged closer to 10% before inflation adjustment. This is why maximizing a Roth IRA or 401k in your 20s is often considered a high-priority financial move for young earners. The tax-advantaged wrapper means gains are never reduced by annual taxes, which amplifies the compound effect even further. Employer 401k matching can provide a significant boost to retirement savings, often matching 50% of employee contributions up to a certain percentage of salary. Many eligible workers leave matching dollars unclaimed every year. Compound Heights is populated almost entirely by citizens who started in their 20s, not because they were richer, but because they started sooner. The towers there aren't built from large bricks. They're built from early ones. The Borrow Badlands tell the mirror story. Citizens there delayed investing while carrying high-interest debt. Compound interest, the same mechanism that builds towers in the West, dismantles them in the East when it works against you. The obvious objection: markets crash. They do. The S&P 500 experienced a significant decline during the financial crisis. But every investor who stayed in a broad index fund and kept contributing recovered fully within 4 years and reached new highs by 2013. For a 25-year-old investor, a market crash is a sale. Every $200 monthly contribution during a crash buys more shares at lower prices. Those discounted shares compound at full value during the recovery. Time converts volatility into advantage. The compounding principle extends beyond money in measurable ways. Researchers have observed that scientists who publish consistently in their 20s tend to accumulate significantly higher citation counts by mid-career than equally talented peers who start publishing a decade later. Here's a number that surprises almost everyone. Waiting just 1 year, from 22 to 23, to start that $200 monthly contribution can significantly reduce your final value at 65. 1 year, one decision. That's the compounding clock running without you. The answer to the opening question is yes. A 13-year head start literally doubles the tower. Not approximately, not metaphorically. The math produces $525,000 versus $243,000. The gap is $282,000 of pure compounded time. The single most powerful financial move available to anyone under 40 isn't finding the perfect stock. It's opening a low-cost index fund account today, setting a recurring transfer for any amount, and refusing to touch it. In Auravale and everywhere else, the tallest towers aren't built by the wealthiest citizens. They're built by the ones who planted the first brick before they felt ready.